Usually, stock market recoveries tend to be sudden and sharp. If you have exited your equity funds, you will be left on the sidelines. By the time you re-enter, it will be too late and your returns will lag behind that of the market. A better way to handle stock market corrections is to stay invested, especially if the money you have put in equity funds is not needed for the next 5 or 7 years. Don't stop your systematic investment plans or SIPs during a market correction. Each installment of the money invested will buy a higher number of units during a downturn. This will boost returns over the long term. Make sure your portfolio is well diversified. In addition to equities, it should also hold debt and gold funds. Having uncorrelated assets in your portfolio will reduce the hit you suffer. Gold typically does well when equities are underperforming, and bond funds do well when the central bank starts cutting interest rates in response to an economic or market downturn. Within the equity portfolio, make sure you have exposure to international funds as well. Different geographies perform in different calendar years. Developed market equities, in particular, tend to have a low correlation with the Indian market. The quantum of downturn suffered by different markets also varies, and that too will cushion the hit to your portfolio. Your portfolio should also have exposure to different styles of funds. Typically, growth funds tend to do better in bullish conditions, while value-oriented funds do a better job of protecting downside risk. Next, check your exposure to mid and small cap funds. Typically, these funds outperform during a bull market and also decline heavily during a downturn. While you should have exposure to them to garner the alpha they are capable of generating, it should be limited. 70% to large caps, 20% to mid caps, and 10% to small caps is a good exposure for retail investors with moderate risk appetite. Finally, ensure that your exposure to sector and thematic funds is limited. Exposure to a single sector or thematic fund should not exceed 5% of your equity portfolio. Cumulative exposure to all sector and thematic funds should not exceed 10 to 15% of the equity portfolio. If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
सब अच्छी दिख रही हैं यार, कौन सी खरीदूं?
ये तो वही बात हुई, 4000 शेयर्स लिस्टेड है, कौन सा लूं?
वो तो सबसे आसान है।
तुझे 5 पैसा नहीं पता?
अब तो सबको पता है। 5 पैसा पर है 4000 स्टॉक्स की रिसर्च, टेक्निकल टूल्स और इन्वेस्टमेंट आइडियाज। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है, investing made easy and rewarding with 5paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.